Last month, a man in Texas sat at a bank ready to sign a home loan with a rate above 6%. He paused and asked a simple question: who decides this number? The banker smiled politely and gave a vague answer. But the truth is far more interesting, and almost nobody talks about it. That number was not chosen randomly by the bank. It was not set directly by the government either. It came from a massive global market that quietly controls money everywhere. This market is larger than all stock markets combined, and it influences your loans, your savings, your job, and even your future plans. Now, think about this. Every time you borrow money, whether for a car, a house, or even a small business, this invisible system is already deciding your cost. It works behind the scenes, but its effects are everywhere. Most people go through life without ever understanding how it works, yet it shapes their financial reality daily. So let's break it down in the simplest way possible. Imagine someone needs money. Instead of going to a bank, they ask the public. They promise to pay interest every year and return the full amount later. That simple promise is called a bond. It is basically an official IOU. For example, you give someone $1,000. They promise to pay you a small amount every year and return your full money after a set time. Sounds simple, right? But here's where things get interesting. The value of that agreement can change depending on what is happening in the wider market. But here's the part most people miss. The price of that bond does not stay fixed. It moves up and down depending on interest rates. If new bonds start paying higher interest, your old bond becomes less attractive. Suddenly, what looked like a safe investment starts losing value. Let's use a simple example. You bought a bond paying $20 per year. Later, new bonds start paying $50 for the same investment. Now ask yourself, who would want your lower paying bond at full price? Nobody. So if you want to sell it, you must reduce the price. This is where many people get shocked. Even though the bond still pays exactly what was promised, its market value drops. You might have paid $1,000, but now it sells for much less. You didn't break any rules, yet you still lost money on something considered safe. So remember this simple rule. When interest rates go up, bond prices go down. When interest rates fall, bond prices go up. This one idea explains many financial events. It may sound basic, but it has caused huge losses, bank failures, and even political changes across the world. Now, here's something surprising. There is one number that quietly controls many financial decisions. That number is the yield on long-term government bonds. Banks use it as a base when deciding how much to charge you for loans. It becomes the starting point for mortgages and many other interest rates. Think about this. If a bank can lend money safely to the government and earn a certain return, why would it lend to you for less? It wouldn't. So it adds extra interest to cover risk. That is why your loan rates are always higher than government bond rates. A few years ago, borrowing money was very cheap. People rushed to take loans, especially for houses. Prices increased quickly because demand was high. But when rates started rising, everything slowed down. Suddenly, fewer people could afford loans, and the entire housing market became quiet almost overnight. But it doesn't stop there. Higher rates affect businesses too. Companies that borrowed cheaply in the past now face higher costs when they need new loans. When expenses rise, companies cut spending, and when they cut spending, jobs are often affected. So this market indirectly impacts employment as well. Now, think about this carefully. When many companies face higher borrowing costs at the same time, the entire economy feels the pressure. Growth slows down, hiring reduces, and uncertainty increases. All of this can happen without most people realizing that the root cause is shifting interest rates. Here's another interesting signal. Sometimes short-term interest rates become higher than long-term ones. This situation is unusual and often signals trouble ahead. Historically, it has predicted economic downturns many times. It's like a warning light that experts watch closely, even if the public ignores it. But here's the twist. Many people were taught that bonds are always safe. They are seen as the stable part of investments. However, this idea is only partly true. Bonds protect you from borrowers failing to repay, but they do not protect you from changing interest rates or inflation. In one recent year, many investors were shocked. Both stocks and bonds lost value at the same time. People who believed bonds would protect them saw unexpected losses. It was a reminder that even traditional strategies can fail under certain conditions, especially when interest rates rise quickly. Let's make it even clearer. Imagine you hold a bond for a long time. If rates rise sharply, its value can drop significantly. The longer the time, the bigger the impact. This sensitivity is measured by something called duration, which tells you how much a bond reacts to rate changes. Now, here's a powerful question. What happens when a bank invests heavily in long-term bonds and rates suddenly rise? The value of those investments drops. If customers start withdrawing money at the same time, the bank may struggle to meet demands. This situation has caused real financial crises. In one case, a bank collapsed very quickly. It had invested in safe assets, but at the wrong time. When losses became visible and customers lost confidence, withdrawals increased rapidly. Within days, the situation became uncontrollable. It shows how even safe choices can become risky under certain conditions. But it gets even more dramatic. Entire countries can feel pressure from this market. When governments make financial decisions that investors do not trust, bond prices fall and interest rates rise. This increases borrowing costs and can force leaders to change policies quickly to restore confidence. Now, think about this. A government plans large spending without clear funding. Investors react by demanding higher returns. This creates a chain reaction affecting pensions, financial institutions, and the broader economy. Sometimes the pressure becomes so strong that political leaders are forced to step down. Here's another surprising story. Some investors once agreed to lend money for extremely long periods at extremely low returns. At the time, it seemed acceptable, but when rates increased later, those investments lost significant value. It shows how decisions made during unusual conditions can have long-lasting effects. But here's the real question. Why should you care about all this? Because these changes affect your daily financial life. From your mortgage payments to your savings returns, everything is connected. Even if you never invest directly, you are still influenced by this system every day. Now let's talk about something practical. Many people keep money in low-interest accounts without realizing better options exist. Some short-term investments offer higher returns with similar safety. Simply moving your money can significantly increase what you earn without taking extra risk. But here's something important. There is a difference between owning a single bond and owning a bond fund. A single bond held until maturity returns your full investment. A bond fund, however, changes value daily and does not have a fixed end date. This difference matters a lot. Think about this carefully. If you see your investment losing value, you might panic and sell. But if you understand how it works, you can make better decisions. Knowledge helps you stay calm and avoid mistakes that many people make during uncertain financial periods. Another useful step is checking how sensitive your investments are to interest rate changes. Some investments move very little, while others react strongly. Understanding this can help you choose options that match your comfort level and financial goals. Now, consider inflation. Even if your money is safe, rising prices reduce its purchasing power. Some investments adjust with inflation, helping protect your money. These options may not be exciting, but they can be very useful in maintaining long-term financial stability. But here's something simple you can do today. Keep an eye on general interest rate trends. When rates rise, borrowing becomes expensive. When they fall, borrowing becomes cheaper. This basic awareness can help you make better timing decisions for loans and investments. Think about this situation. You are planning to buy a house. If rates are high, your monthly payments will be higher. Waiting for better conditions could save you a significant amount over time. Small differences in rates can lead to large differences in total cost. The same applies to businesses. When borrowing costs increase, expansion becomes harder. Companies may delay growth plans or reduce expenses. This affects job opportunities and overall economic activity.
So even if you are not borrowing, you still feel the impact indirectly. But here's a question. Have you ever wondered why economic conditions change so quickly? One reason is that this market reacts fast. It reflects expectations about the future, not just current conditions. This forward-looking nature makes it a powerful influence on decisions. Now, imagine the entire system as a network. Every part is connected. Changes in one area spread to others. Interest rates affect borrowing, borrowing affects spending, and spending affects growth. Understanding this chain helps you see the bigger picture. Here's another insight. Governments borrow large amounts of money. The cost of servicing this debt depends on interest rates. When rates rise, the cost increases. This can limit spending on other areas and influence economic policies. Think about this carefully. If a large portion of government income goes toward interest payments, less is available for development. This creates long-term challenges and forces difficult decisions. It also shows how important stable rates are for economic planning. But here's something interesting. Investors from around the world participate in this market. Their decisions influence demand and prices. When confidence changes, their behavior changes too, affecting global financial conditions. Now ask yourself this. What happens when fewer investors are willing to lend at low rates? The answer is simple. Rates must increase to attract them. This is basic supply and demand, but applied on a massive scale. Here's the key takeaway. This market constantly adjusts based on expectations, risks, and opportunities. It is always moving, always reacting. Even small changes can have large effects because of the scale involved. But don't worry, you don't need to become an expert to benefit from this knowledge. Just understanding the basics can help you make smarter decisions and avoid common mistakes. Think about your financial future. Every decision you make, from saving to borrowing, is influenced by these factors. Being aware gives you an advantage over most people who never think about it. Now, consider this. Many people focus only on income, but managing costs is just as important. Interest rates directly affect costs, so understanding them can improve your overall financial health. Here's a simple habit. Before making a major financial decision, check current rate trends. This small step can help you choose better timing and avoid unnecessary expenses. But here's the truth. This system will continue to operate whether you understand it or not. Ignoring it does not protect you. Learning about it gives you control and confidence. Now, think about this. You don't need complex strategies. Simple awareness and smart choices can make a big difference over time. Consistency matters more than complexity. Here's something encouraging. Financial knowledge is not reserved for experts. Anyone can learn the basics and apply them. The key is starting with simple concepts and building from there. But here's the final thought. The numbers you see on loans are not random. They reflect a larger system at work. Understanding that system helps you see beyond the surface. Now, imagine making decisions with this awareness. You would approach borrowing differently, save more effectively, and plan better for the future. That is the real value of understanding how money works. Think about where you are today and where you want to be financially. Small improvements in knowledge can lead to big results over time. Here's the bottom line. This market influences your life more than you realize. But once you understand it, you are no longer guessing. You are making informed decisions. And that changes everything.